Okay, so in this video, we're going to do something very simple. I'm going to give you a 5 to 10 minute professional grade Wall Street level analysis and explanation of what is going on with the stock market, how long this will continue. Is this something permanent or is it just a temporary thing that's going to blow over? And more importantly, I'm going to give you a strategy, actual tools you can use to make money even in this crazy, insane market. Stick around. This is going to be a lot of fun.
My name is Tom Nash, and I quit my corporate job as a senior financial analyst to break down companies for you. But there's one thing you need to know about me: I don't take bullshit from anybody.
What the hell is going on with this crazy market? How long will this continue? What's my strategy for the next week or 2 weeks? And how do I plan to make money even in this volatile, crazy market? Now, before I get started, we can't skip any of the stages. Now, if I just go to the solution, you won't understand it if you don't understand the basics, basically the cause and effect. What is causing it, why it's happening, and how this all plays into the actual solution that I have for you. So stick around with me. It's going to be quick. It's going to be painless. You know I'm going to run a few jokes, so we're going to have some fun. So I know I'm about to talk about bond yields, inflation, so don't fall asleep. Stay with me because this is actually going to get very interesting. Trust me. So what is inflation and why inflation is the evil character in this crazy story, right? If this is a book or a movie, inflation is that evil character with the horns and the black suit. Well, not so fast. Okay, so inflation in general is basically how much more expensive the shit you buy actually costs, right? Starting from the price of a Big Mac all the way to your shoes, to your phone, and even the raw materials that make our cars and our stuff, right? So the better the economy is, the richer people get, the more people spend, the more they compete for the same amount of goods, rising the price of goods. I mean, because just straight up 101 economics means more demand, higher prices, right? So when things are good, inflation keeps going up. It's normal and it's okay as long as you can control it. I mean, controllable inflation is actually very good for you. Anywhere in the vicinity of 2% is actually very healthy because it actually shows me that the market is doing well. However, here's where you have a problem. When inflation spirals out of control, it's pretty much like a nuclear reactor. By the time you see that happening, it's already too late. The roof has already flown from the reactor and everything is spewing outside and you're basically fucked. Now, in order to prevent this, the Federal Reserve has some brakes and some accelerators, how to control the speed of the market. And that is the interest rate, the famous interest rates. And I'll explain in a second why. So basically, Jerome Powell went on TV and basically said, hey, dear market, we're not concerned about inflation spiraling out of control right now because literally the market is doing bad. He was talking not about the stock market, but the actual market. Not enough jobs, not enough participation in the workforce, a lot of economic analysis that basically shows him as the chair of the Fed that things aren't doing amazing yet. And if things are not doing amazing yet, he's not looking to see a lot of inflation because the market is not doing that well. However, everybody kept selling during his speech and after, and the question is why? Well, I'll explain why. Because what Jerome Powell did not mention, and a lot of people kind of understand, is that when you're talking about the fact that you don't see a high participation in the job market, which is true, you're still forgetting the other element. The other thing that may cause inflation if you just give people money. Let me tell you a story. Imagine a king, right? Living in a castle. And that king hired some contractors to paint his windows. And then he needed to pay them. And he had a safe with a few gold coins, right? So he goes to the safe to pay to the contractors. Can't find the key. Where the hell is my key? Where the hell is my key? Can't find the key. Anyways, so he's the king. You know, he has the royal seal. So he gives him a piece of paper and says, hey, you can use it. It's as good as my coins. Trust me. Everybody will see my seal. Nobody will say nothing. Contractors pretty much said, yeah, why not? I mean, fuck it. That sounds good to me. They took the fucking papers. They go to the bar. They buy a few drinks. They buy lunch. Everything is Gucci. Now, the next day, the guy comes in to clean the pool. And another guy comes in to fix the floors and to fix the gate and whatever. Now, at some point, the king stops even looking for the key because he says, why the hell do I need the key? I'm just going to give out this paper, right? And what happened next is actually very amusing because the king kept throwing around these papers like it was nothing. Everybody got filthy rich. The carpenter is now driving a Maserati, right? The gardener is driving a Porsche. The bartender drives a Tesla Model S, whatever. They're all so rich. The town is doing amazing. But now that everybody has a shit ton of money, prices go up because people have more money. They're spending more. Shit costs more, right? So inflation actually starts to kick in into the market. However, at some point, all of these people kind of, sit around the bar and then like, well, we have all this money from the king. And then they realize that everybody is holding this piece of paper and they're seeing now everybody has gazillion worth of coins in their paper. And somebody says, well, there's no way the king actually has that many coins. I mean, there's no way he can pay us all. And all of a sudden, you see the light bulbs go up through the entire bar and the street, and the entire village with their pitchforks start to run towards the castle. Now, the king sees that. He locks up the castle. Everybody's banging on the doors. Give us our gold coins, blah, blah, blah. This is basically Argentina when everybody's rushing to the bank to get their cash and the banks. So that kind of story, as amusing as it is, actually very concerning because it goes to show you that by the time you notice inflation, it's probably too late. Now, how does this have to do with the US stock market? If you're still with me at this point, I'll explain. So, if people are getting free money, which they are, stimulus bills, printing of endless money by the Fed, buying junk bonds. So the Fed has been throwing a shit ton of money on the market. In fact, they printed 40% of the US dollar in the past year alone. In fact, they just passed a stimulus bill literally yesterday, a $1.9 trillion stimulus bill, $1,400 a pop. You get a check, all Gucci, right? By the way, that bill still has to go through the House before Biden signs it, but it's pretty much a done deal. And at this point, I want to talk to you about trains. Hold up a second. I haven't lost my mind. I'll explain why. Imagine the economy is a train, and when everything is nice, everything is smooth, the train is going at like 45 miles per hour, everything is relaxed, everything is smooth, people are sipping tea, everything is relaxed. Imagine the Fed being the driver of the train, right? The engineer, whatever they're called. I don't know. I don't know how they're called. Anyways, so the driver decides to go full throttle on the gas by lowering the interest rates to zero, which is essentially what it is. Well, you know what happens at this point? The train goes berserk, out of control, and that tea thing is like the tea spills all over this shit. You know, people are flying around, suitcases flying around, everything's completely mayhem. You can't even stop the train at this point. You're trying to press the brakes, but the train is completely out of commission. It's a runaway train, can't break it, can't stop it. That's the horror scenario. Now, here's the thing. Speaking about trains, if the economy is a train, the brakes and the accelerator is the interest rate. If you lower the interest rates, basically what happens is you accelerate the economy. Less saving, more spending, but also more inflation. But if you actually raise interest, you encourage savings, less spending, less inflation, but also the market suffers. And if the market ain't doing so well, raising interest is a problem. So Jerome Powell is kind of stuck between the rock and the hard place. Can't raise it, can't lower it. He's either going to crash the economy or the stock market. He's pretty much fucked. Now, how do we know what he's going to do? I mean, apart from the fact that we probably need a crystal ball to do that, which we can't get, there is actually a crystal ball in the market that nobody has told you about. And this is a good time to start talking about the bond yields. A lot of talk about bond yields. I'm convinced that 90% of people on TV talking about it have no fucking idea how it works. It's so amusing. So nobody has bothered to explain to you how bond yields actually have to do with foreseeing inflation and actually impacting the actual stock market. And I'm going to do it in literally 30 seconds. Check this out. So bond yields is essentially how much you get for a bond. It's your return on the bond. The lower the price of the bond that you're buying, the better the return is, right? Simple. If you buy something cheap, you get a better deal. You buy something expensive, you get a shittier deal. That's the whole concept of the yield. Now, why do the yields keep going up so fast, so sharply? Well, because T-bonds, especially the 10-year ones, are a clairvoyant of what's going on with inflation. Because if nobody's buying it at 1.6%, which seems actually true at this point, it means that everybody in the market assume that the inflation rate is going to be higher than 1.6%. Why? Because if you buy a 10-year T-bond at 1.6 and the inflation is 2%, you pretty much lost money by buying the shit, which makes no sense. And that is why if you see a radical parabolic rise in T-bonds, which we've seen in the past few weeks, it means that the entire market doesn't believe that inflation is going to stop. That means that the market thinks entirely that inflation is here. That means it makes no sense to buy these T-bonds. When nobody's buying the T-bonds, what happens to the price? Goes down. What happens to the yield? Goes up. So when you see spikes in T-bond yields, everybody's selling off the stocks. Why? Well, they're selling off specific kind of stocks. As you noticed in the past 2 weeks, which stocks did we see underperform and go crazy? Tech. Why is tech so suffering because of bond yields? How do these two even are connected? I'll explain in a second. So, if the bond yields is your clairvoyant for what's going on with inflation, the bond yields is a good indicator what's going to happen with interest rates. Because what is the only way the Fed has to control inflation? Interest rates. So if everybody thinks that inflation is going out of control or getting bigger or getting worse, whatever you want to call it, that means that the market is anticipating an increase in interest rates. That means that our famous discounted cash flow valuation models, if you've seen me do a few of these, essentially discounting future cash flows from year 5, 6, 7, 8, 9, 10 back to today, they're going to suffer. Because if there's one thing that extremely impacts these models, is at what rate are you bringing back future money to today? The higher the rate, the lower the amount you get today. It's very, very simple. I'll explain why in a sentence. And here's a simple numerical example that's going to make you laugh at how simple this shit is. If I deserve 1.1 million next year and I want to cash it out today, how much do I deserve? Well, if the discount rate is 10%, I get a million. Because if I took that million, put it in the bank for a year at 10%, I get 1.1 million. As simple as that. And now imagine the interest rate is not 10, it's 0 like we have today. Then 1.1 that I'm due next year is worth 1.1 today. I literally got 100,000 more just because the interest rates have changed. That is the whole concept. In DCFs, the discount rates, which are called the weighted average cost of capital, is essentially interest rates. When they're going high, you're getting less money today. When they're going low, you're getting more money today. Which companies are more susceptible to this than others? Companies with future, with vision, with a dream, with a story. Established companies that make money today, make money today, have established cash flows today, are not as sensitive to this as companies that make no profit, no real revenues today, and they're talking about some future thing that's going to happen in 5 to 10 years. That is why biotech and specifically tech is really susceptible to this, because a lot of these tech companies are selling a dream, which is fine. Now, here's the thing. How all this crazy mumbo jumbo about trains and fires and whatever we talked about, the king printing money, whatever. How does this have to do with actually making money in this crazy actual environment? Well, I haven't forgot about you. Check this out. So, what do I plan to do for the next couple weeks? My strategy is based on the assumption that this thing is permanent. It's not going away anytime soon because the conditions will not change. Interest rates will have to go up because inflation is going to go up. Look at the semiconductors, look at the raw material, look at the stimulus they just passed, 2 trillion. There's a lot of money going in. Low interest rates will have to go up. So that means this isn't something that's going to go just blow over in the next 2 weeks. It's kind of a new reality we have to deal with. Now, that doesn't mean I'm selling my tech stocks because I do believe the ones that I actually hold, I have full conviction that they're going to do well. The Palantir, the Tesla, the BCRX, the BNGO, they're staying. However, it's time to add shit to your portfolio that makes sense in this new environment, the high inflation, high interest rate environment. In that sense, a lot of people are FOMOing into shitty stocks. And let me explain what I mean by that. So what they're doing actually right now is buying up stock that makes no sense. Airlines, casinos, parks, all of this nonsense. I mean, I'm sure they're going to reopen at some point. I'm sure they're going to be making money. But everybody's sending these guys parabolic way, way before we even know exactly what's going on. Not to mention the fact that we're talking about economy 2.0, not the economy of yesteryear. Now, here's what happened. The pandemic actually accelerated a lot of the processes that were going on before the pandemic, including brick and mortar slowly dying. Now they're completely dead. E-commerce is the next big wave. I think we're about to see a massive awakening of the economy through e-commerce, and actually kind of fuels into my assumption that inflation is going to go higher because when the market is doing well, inflation goes up, interest rates will go up. So it's one more accelerator to my assumption about interest rates, but we're not talking about that right now. So e-commerce is the next big wave. Now, people think that e-commerce is the birth of the pandemic. No, motherfuckers. E-commerce was killing brick and mortar way before the pandemic. This whole thing just accelerated it. Now, if you're thinking about buying hotels and airlines and casinos and parks, that's all nice and dandy. I'm sure they'll make money, but the prices are so parabolic at this point. People have bought it out of FOMO all the way up to the moon. They don't make sense in this risk because you don't know how soon this will open up. These guys will have to rehire a lot of people, retrain a lot of people, reestablish infrastructure. There's a lot of ifs there. Not to mention the fact that I actually think that the patterns of enjoyment and employment will change to the point that they'll actually make less money, but that's a whole different discussion. So, if you actually want to invest in rotation and recovery stocks that make sense, that actually have not been priced like these casinos and hotels and airlines, there is a way to do it. Because while this whole tech sell-off was going on, there's one thing that happened that actually amuses me, but presents a massive opportunity. People that don't understand what I just explained to you started selling off tech. Anything that had the word technology in it, people sold it because they said, well, tech stocks are going down. What happened? They ended up selling Apple. They ended up selling Google. They ended up selling Facebook. I mean, those are three stocks that are tech stocks. That's true. But they're currently massively profitable today. They make no sense to be included in the group of the future stories, the hopes, the visions. So them going down makes no sense, meaning that you can join the smart money who's going to start buying up these stocks slowly. They don't want to run up the price as things progress. So Apple, Facebook, Google, not to mention Disney. Disney is one of those stocks that is perfect for this because Disney suffered from the pandemic. The whole parks and the physical assets suffered a lot. So you're getting that recovery stock in there. But also Disney is going to be massive in streaming. Have no doubt. Disney Plus is going to shellac everybody, including Netflix, by the next 2 years. Disney Plus is going to be the king of streaming. Disney is going to be massive. So it's kind of that stock that went down because of the pandemic, because of the parks and all that stuff. It's going to see a huge reopening, huge recovery, but also a lot of e-commerce and streaming, which is also one of those things you want to be in post-pandemic. So what I'm going to do in the next 2 to 3 weeks is actually buy up as much as I can Disney, Apple, Facebook, and Google. I'm going to be adding those as much as I can to my portfolio to make it more suitable to this new high inflation, high interest rate environment, because this is not going to wait. So start planning ahead for that. Don't just say, well, it's going to blow over. It's not. The rules of the game have changed. You can't stay stagnant just because you hope it won't. It's not that. You have to be smart about it. You have to pivot your way into this new reality. I'm thinking about adding 15 to 20% of my stocks into this whole new recovery digital mode. And I suggest you actually search for your own opportunities, do your own research, because at the end of the day, this is just my opinion. I'm just some guy on the internet. Check your facts, do your due diligence, because my opinion might be inaccurate, might be wrong, might be the ramblings of a madman. Who knows? Do your own thing, do your own due diligence, do your own research, allegedly. Blah, blah, mother effing blah. Thank you for channel members and Patreons. You guys have been amazing supporting the channel. We'll see you guys in the next video.